Yeah, in the book Reminiscences of a Stock Operator, my favorite book, Jesse Livermore, who made billions and lost billions in the Roaring Twenties and the Great Depression, he often talks about the shoeshine boy when he's giving tips, or
Yes.
the newspaper boy.
Yeah.
That's always, the best time to sell.
Yeah,
Yeah.
that's my regret, man. I only got like 2 chapters into that book. It's a good book. Sorry, Caitlin.
No, I was just gonna say I gotta read that. That's next on my list.
You have to read it. It's an enjoyable read, and like he didn't actually write it, like someone else wrote it, but it's just an enjoyable read. And he was kind of like a little bit of I want to say like ahead of his time with technical analysis,
Hmm.
because back in the day you would go to these like illegal sort of like underground trading houses, and there'd be kids that like on a chalkboard they would write the price of different shares, right? And they would update them like every hour, right? Because they would come through like telegraph or whatever.
Hmm.
And that's how you would trade. You wouldn't have a computer. That I don't think everyone had access to a ticker tape. So like he was one of those boys that was like writing the numbers and then erasing them. And every hour he would write down a new number, and he would realize that the numbers, like, they made sense to him. Like there were support and resistance lines. Like he was writing it down, and like it just made sense how things were moving. So then he started putting money down and he started making money because he like it was really rudimentary technical analysis. Like he was doing like support and resistance, and when you make a new high, you buy, and then when you make a new low, you sell. But it actually worked, and the market was just so inefficient back then.
Inefficient. Yeah.
Hmm.
So those
Yeah.
things work. Like imagine if you, with your trading expertise, were trading back then,
Taking
It's just so different, man.
and
I couldn't even imagine.
everybody was trading on tips back then. Like no
Yeah.
one really knew what they were doing for sure. And the other interesting thing about that is that people were able to take, I think, like leverage to the point where you were only able to put like 2% down. So you could be like 98% leverage.
Hmm.
Yeah. So like just imagine the margin calls that you would get on that.
Yeah, that's
Things were
wild.
just way more volatile. And there's regulations in place for that now.
Well, plus your spreads on those, like back, I don't know what it was in the 20s, but I know even in like the 70s, it was like, even in the 70s, it was probably still like half a cent, right? Or like half a dollar, sorry. It's like the spread would be like, say $26 and 26.50. So like if you buy on the ask, you sell right away on the bid, you're already down 50 cents. And then it just like
Yeah.
over the years, it slowly, and then it became a 25 cents and then 15 cents, and it just kind of narrowed all the way up to a penny.
Yeah, I think the spreads were pretty big. If I can recall, he was like buying, they were like 25 cents or whatever. And it's just really interesting. The companies that they were trading back then, they were all like either material companies or railroads. Like they were just like one of the two. Like that's why they call it the Dow Jones Industrial Average, because I think there was a rule that like 28 out of the 30 companies on the average had to be railroads. Like it's just really funny compared to now. Like there's what, like how many industrial companies are there on the Dow? You have Caterpillar, Boeing, Dow Chemical. I can't think of any others, right?
Yeah.
So it's pretty funny.
Yeah, I got to read that one.
Yeah,
Yeah.
you got to read it. I usually read it every couple of years. I'm gonna read it for like the fourth time, probably in a couple months.
Yeah. Yeah.